Good afternoon, everyone. Welcome and thank you for joining us today. My name is Zach, and I'm the Outreach Coordinator here at the Taxpayers Help Center. I'm excited to be here with you to discuss business entities. The Taxpayers Help Center is a nonprofit 501c3 organization in Northridge, California. We operate two clinics, one of which is our Low-Income Taxpayers Clinic, in which we help taxpayers resolve their tax disputes with the IRS, or also known as the Internal Revenue Service. And then the other clinic is our Volunteer Income Tax Assistance Clinic, also called VITA, and we help prepare income taxes for free. And then we are an IRS authorized certifying acceptance agent, CAA, for individual taxpayer identification number, also called ITIN applications. And our clinic director is Masood Chotani, and then I, Zach Golan, am the outreach coordinator for the Taxpayers Help Center. And today during the presentation, we'll discuss choosing business entities. We'll discuss sole proprietorship, partnership, limited liability company, C corporation, and S corporation. So if you'd like to connect with us, our email is info@taxpayershelpcenter.com. Our Facebook is Taxpayers Help Center, Inc., a nonprofit organization. We are located at 9029 Reseda Boulevard, Suite 209, Northridge. And then our website and telephone are right here. But also all this information is on Google. So if you just search up Taxpayers Help Center, all this information is readily available. Also, if you have questions at any time watching this presentation, you can email us at info@taxpayershelpcenter.com, and a tax professional will get back to you. The Taxpayers Help Center helps taxpayers both locally and beyond. Since the services we provide are free, donations are important in supporting us and in helping the reach of our services. Any monetary donations are greatly appreciated. Those who can volunteer their time or expertise or spread awareness are also great help. If you would like to make a monetary donation, you may do so at taxpayershelpcenter.com/make-a-donation, or probably the easier way is if you just go to taxpayershelpcenter.com and click on the Make a Donation tab. If you look at this image over here, it's highlighted in a red circle. But again, anything is greatly appreciated as these donations allow us to do what we do. Today, our presentation is on choice of business entity, and we will discuss the types of business entities and their legal and tax characteristics. When starting a business, choosing the right entity is a crucial decision that can significantly impact future success and sustainability of your venture. This choice is primarily influenced by two critical factors: legal liability and taxation. Types of business entities. So the first one that we're going to talk about is sole proprietorship. And a sole proprietorship is the simplest and most common form of business entity. It is owned and operated by one individual, and there is no legal distinction between the owner and the business. This means the owner is personally liable for all business debts and obligations. Profits and losses from the business are reported on the owner's personal tax return, making tax filing straightforward. However, one of the downsides is the lack of liability protection. The second is partnership. A partnership involves two or more individuals who share ownership of a business. There are two primary types. So one is the general partnerships, and then the other is limited partnerships. In a general partnership, all partners share equal responsibility for the business's debts and obligations, as well as profits. In a limited partnership, there are both general and limited partners, with limited partners having restricted liability and involvement in management. Partnerships benefit from pass-through taxation, where profits and losses are reported on the partner's personal tax return. So this basically means that it's taxed once. The corporation and the partnerships that benefit the pass-through taxation basically means you're taxed once. There's no corporation and then personal tax. But however, general partners remain personally liable for business debts. And then there's the limited liability company, which is also and more commonly referred to as LLC. And so LLC offers the liability protection of a corporation with the tax benefits and simplicity of a partnership or sole proprietorship. LLC members are protected from personal liability for business debts with their risk limited to their investment. This structure allows for flexible management by either members or appointed managers. Profits and losses pass through the members' personal tax returns, avoiding double taxation. LLCs require fewer formalities and can have unlimited members, including individuals, corporations, and foreign entities. Ideal for small to medium-sized businesses, LLCs provide liability protection, tax flexibility, and a simpler management structure compared to corporations. Next off is the C corporation. A C corporation is a separate legal entity from its owners, providing strong liability protection. Owners or shareholders, owners, so also referred to as shareholders, are not personally responsible for the corporation's debts and obligations. C corporations are subject to corporate income tax and profits are taxed at the corporate level. So this is the opposite of how it was for LLC, where it's just one of the benefits is that it's taxed once, but with the C corporation, income is taxed at the corporate and personal level. So if profits are distributed to shareholders as dividends, they're taxed again at the individual level, as I just mentioned, leading to double taxation. However, C corporations can raise capital more easily through the sale of stock and benefits like employee stock options. S corporations. An S corporation combines the benefits of a corporation with the tax advantages of a partnership. It is a separate legal entity providing liability protection to its owners. However, unlike C corporations, S corporations can avoid double taxation. Profits and losses are passed through to the shareholders' personal tax returns, and the corporation itself is not taxed at the federal level. There are restrictions on S corporations, such as a limit on the number of shareholders and the requirements that shareholders be U.S. citizens or residents. This structure is often beneficial for small to medium-sized businesses seeking liability protection without the burden of double taxation. Sole proprietorship. So now we're going to go more in depth on sole proprietorship. So there is one owner, unlimited liability. Owner is liable for debts of business, individual income tax, and income is reported on Form 1040 and taxed at individual rates. So a sole proprietorship is the simplest and most straightforward form of business entity characterized by having a single owner. This structure offers complete control and decision-making power to the owner, allowing for flexible and quick business decisions. However, it comes with unlimited liability, meaning the owner is personally liable for all debts and obligations of the business. This lack of separation between personal and business assets puts the owner's personal property at risk in the event of business financial troubles or legal issues. For tax purposes, the business income is treated as the owner's personal income. All profits and losses from the business are reported on the owner's individual income tax return, specifically on the Form 1040. In a moment, I'll show you what it looks like. It's the Form 1040 Schedule C. So that's the one that is specific to businesses. And the income is then taxed at the individual rates, which can simplify the tax filing process, but may result in higher tax rates if the business is highly profitable. Despite its simplicity, the unlimited liability aspect makes the sole proprietorship a riskier option compared to other business entities with liability protection. So just an example of a type of business that may, this type of entity may fit them, is if, let's say, Joe decides to create a lemonade stand and Joe does business selling lemonade by himself. That is a sole proprietorship and he is liable for the debts of his company. But in his case, since it's unlikely that it would be anything that it would grow into any, big company, it seems like it's the best decision for a business like that. And then this is the 1040 Schedule C. So the Form 1040 Schedule C is a tax form used by sole proprietors to report income or loss from their business. Here's what it looks like. And then some of the key features are income reporting. So this lists all business income, including sales, service, and other earnings. Expense deduction, which allows for the deduction of business expenses such as advertising, utilities, supplies, and travel. Okay, partnerships. So one, there are two or more owners. So a partnership involves two or more individuals who share ownership and management responsibilities of the business. This collaborative approach allows for pooling of resources, expertise, and capital. Each partner contributes to the business's operations and decisions, which can lead to a diverse range of ideas and skills being applied to the business. Liability protection varies depending on the type of partnership, so whether it's a general partnership or a limited partnership. In a general partnership, all partners share equal responsibility for managing the business and are jointly and severally liable for all debts and legal obligations incurred by the business. This means that each partner can be held personally responsible for the business's liabilities, which can put their personal assets at risk. In a limited partnership, there are two types of partners. So the general partners and limited partners. General partners manage the business and have unlimited liability for business debts, while limited partners have liability protection limited to their investment in the business. Limited partners typically do not participate in day-to-day management, and their risk is restricted to their financial contribution. And then third, the flow-through entity. So a partnership is considered a flow-through entity, meaning that the business itself does not pay federal income taxes. Instead, the income, deductions, and credits of the business flow through to the individual partners. This structure allows profits and losses to be reported on the partner's personal tax returns, potentially reducing the overall tax burden. And then no income tax is paid by the partnership itself. The partnership does not file a separate income tax or pay income taxes as an entity. Instead, it files an informational return, so using Form 1065, which we'll go over in a minute, with the IRS, which reports the partnership's income deductions and other relevant financial details. The partnership's tax obligations are passed on to the individual partners who then report and pay taxes on their share of the income. And lastly, partners are responsible for paying taxes on their share of the partnership's income. Each partner is responsible for reporting their allocated share of the partnership's income, deductions, and credits on their personal tax return. This share is determined based on the partnership agreement, and typically reflects each partnership's ownership percentage or other agreed upon allocation methods. The income is taxed at the individual partner's personal income tax rate, which can vary depending on their overall income level and tax bracket. So oral or written agreements. So these can be established through a formal written document or informal oral agreement, though a written agreement is generally recommended for clarity and legal protection. Contributions and distributions. So it specifies the terms for each partner's initial and ongoing financial contributions to the business and the manner in which profits or losses will be distributed among the partners. Capital accounts. So detail how each partner's capital account will be managed, reflecting their financial stake in the business, including initial investments and any subsequent changes, profit, loss, and capital sharing ratios, including special allocations. So this outlines how profits and losses will be allocated among partners, as well as how capital will be shared, including any special arrangements or allocations that deviate from standard ratios. And then tax elections. So this describes any tax elections the partnership chooses to make, such as the Section 754 election, which allows adjustments to the basis of partnership property in the event of certain transfers or distributions. And then lastly, partnership representative for IRS audits. So this designates an individual who will act as the point of contact and represent partnership during IRS audits or other tax-related matters. And so this is the Form 1065. And this form is used by partnerships to report their income, deductions, gains, losses, and other financial information to the IRS. So some of the features on this form are partnership reporting. And so this details the partnership's financial activities, including income and expenses. The information return, it is an information return, meaning the partnership itself is not taxed. Instead, the income or loss is passed through to the partners. And then the Schedule K1. So each partner receives a Schedule K1, which reports their share of the partnership's income, deductions, and credits to be included on their personal tax returns. Next off, limited liability company, also referred to commonly as LLC. And so this provides members with limited liability while allowing active participation in the business. So members of an LLC have protection from personal liability for business debts and claims similar to that of a corporation. At the same time, they can be actively involved in managing the business without risking their personal assets. 2, entity formation. So this is created by filing articles of organization with the state government. And then so to establish an LLC, you must file a document called Article of Organization with the state's business registration office. This document formally creates the LLC and includes basic information about the business. And so one of the other reasons why someone with a smaller business, such as Joe in the example that I mentioned earlier. So one of the reasons that why they may not want to be an LLC, for example, is because you have to pay money to the state to have that entity. It's not anybody can, it's not something that anybody can get for free. You have to pay, and it takes time and effort, and you have to renew it. So it's really more if you have a real strong business. So then number 3, the operating agreement. So this regulates the business activities and in member rules. An LLC's operating agreement outlines the internal rules and procedures for managing the business. It details how decisions are made, how profits and losses are distributed, and the roles and responsibilities of each member. And then 4, self-employment tax. The liability for members depend on their level of involvement in the business. Members of an LLC may be subject to self-employment tax based on the role in the business. If actively involved, they generally pay this self-employment taxes on their share of the LLC's income. If not actively participating, they might have different tax obligations. And then there's also LLP, which stands for limited liability partnerships. It is similar to an LLC in many ways, but it applies to professional businesses such as law firms. So here are the forms 1065 and 1040 Schedule C again. A limited liability company would use one of these forms depending on whether it's a partnership or sole proprietorship. If the LLC is a partnership, the Form 1065 would be used, and if the LLC is a sole proprietorship, the Form 1040 Schedule C would be used. C corporations. So corporation formation is established by filing incorporation documents with the state authority. And to form a corporation, you must file specific documents such as the Articles of Incorporation with the state's business registration office. This filing officially creates the corporation and includes essential information such as the corporation's name, purpose, and structure. The process ensures that the corporation is legally recognized and compliant with state regulations. Second is limited liability. So all shareholders have limited liability protection provided the corporation is compliant with state laws. Shareholders of a corporation are protected from personal liability for the company's debts and legal obligations. So this means Their personal assets are generally not at risk if the corporation faces financial difficulties or legal issues. This protection applies as long as the corporation adheres to state laws and maintains proper corporate formalities such as holding regular meetings and keeping accurate records. Third, so they have double taxation. So the corporation pays taxes on its taxable income. A corporation is considered a separate legal entity and must file its own tax return. It pays taxes on its earnings at the corporate tax rate, which can vary depending on the jurisdiction and the amount of income. Shareholders pay taxes on dividends received. When the corporation distributes profits to shareholders as dividends, these dividends are subject to personal income tax at the shareholder level. This results in double taxation because the income is taxed once at the corporate level and then again when distributed to shareholders. So this is the Form 1120. Form 1120 is used by corporations to report their income, gains, losses, deductions, and credits to the IRS. And some of its key features are corporate reporting. So it details the corporation's financial activities, including revenues and expenses. Taxable income calculation. So this calculates the corporation's taxable income, which is subject to corporate income tax. Deductions and credits. So this allows corporations to claim deductions and credits to reduce their taxable income. And then annual filings. So this must be filed annually by domestic corporations, including C corporations. Next off, and the last type of business entity we're going to talk about are S corporations. So all shareholders have limited liability provided the corporation complies with state laws. Shareholders of an S corporation are protected from personal liability for the corporation's debts and obligations similar to a C corporation. This means that as long as the corporation adheres to legal requirements and maintains its corporate status, shareholders' personal assets are shielded from business liabilities. This protection is contingent upon following state laws and corporate formalities. Second off, flow-through entity. So income passes through to shareholders for tax purposes. So unlike the C corporations, with the S corporations, it's taxed once and not twice. An S corporation is classified as a flow-through business, as a flow-through entity, meaning that the business itself does not pay income taxes. Instead, the income deductions and credits of the corporation flow through to the individual shareholders, which I just mentioned, who report these items on their personal tax returns. This setup helps avoid the double taxation typically associated with C corporations. S corporations do not pay income taxes directly, with some exceptions for prior C corporations in specific cases. And S corporations are generally not subject to federal income tax. Instead, they file an informational tax return and their income is taxed at the shareholder level. However, if an S corporation was previously a C corporation, it may still be subject to certain tax rules and liability from that period, such as accumulated earnings tax or built-in gains tax under specific circumstances. And then 4, shareholders pay taxes on their share of income from the corporation. So shareholders of an S corporation are responsible for paying taxes on their proportional share of the corporation's income, deductions, and credits. This income is reported on their individual tax returns and taxed at their personal income tax rate. This pass-through taxation ensures that the corporation's earnings are taxed only once at the shareholder level. And then lastly, formation. So it's typically the same process as for a C corporation. Formation of an S corporation follows this process similar to that of a C corporation. This involves, as I mentioned, or I think I mentioned on the last slide, but filing articles of incorporation with the state, drafting bylaws, and meeting other state-specific requirements. The key difference lies in the tax treatment and election of S corporation status, which must be filed with the IRS to obtain flow-through tax treatment. And some of the requirements are domestic corporation. So this means that the corporations needs to be formed in a state in the United States. There has to be 100 or fewer shareholders. And so an S corporation can have a maximum of 100 shareholders. This limit ensures that the corporation remains relatively small and manageable. And all shareholders must be individuals or certain trusts or estates. Other types of entities like corporations or partnerships cannot be shareholders with some specific exceptions. Third, no corporate partnership or trust shareholders, as I just mentioned. And so generally S corporation shareholders must be individuals. However, there are some exceptions for certain types of trusts and estates, such as qualified trusts or certain types of charitable remainder trusts. Corporations and partnerships are not permitted to be shareholders, though there are limited exceptions for specific types of trusts and entities that meet certain criteria, and they have to meet this certain criteria, but generally, the exceptions are very limited. And so for no non-resident shareholders, so all shareholders must be U.S. citizens or resident aliens. Non-resident aliens are not allowed to hold shares in an S corporation. This requirement helps ensure that the tax benefits of S corporation status are restricted to U.S. taxpayers. And then lastly, one class of stock, so no preferred stock allowed. An S corporation is limited to issuing only one class of stock, which means all shares have equal voting rights and liquidation preferences. This restriction prevents the issuance of preferred stock, which typically has different rights and privileges compared to the common stock. This uniformity simplifies the ownership structure and ensures equitable treatment of shareholders. And so this is the form used by S corporations. It's called the Form 1120-S. And so this is the form that they use to report their income gains, losses, deductions, and credits to the IRS. Some of its key features are it has S corporation reporting. So this details the financial activities of an S corporation, which is a corporation that has elected to pass corporate income, losses, deductions, and credits through their shareholders for federal tax purposes. It has pass-through taxation. So the form itself reports the corporation's income and expenses, but the corporation generally does not pay taxes at the corporate level, as we had talked about. Instead, income or loss is passed through to the shareholders and reported on their individual tax returns. And then it has Schedule K1. So each shareholder receives a Schedule K1, which reports their share of the corporation's income, deductions, and credits to be included on their personal tax returns. Then annual filings. This must be filed annually by S corporations to fulfill their tax reporting obligations. So the 1120-S and the 1120 are pretty similar in what they have. It's just one is for C corporations, and this one is for the 1120-S is for S corporations. So just to recap, limited liability and tax minimization are the main objectives when choosing a business entity. So one of the primary reasons for selecting a specific business entity is to protect personal assets from business liabilities while optimizing tax benefits. So for instance, a limited liability company, LLC, provides limited liability protection while offering flexible tax treatment options, such as pass-through taxation. But conversely, a C corporation may be chosen for its ability to raise capital through stock offerings despite its double taxation drawback. Second, no single solution fits all situations. And so the choice of business entity depends on various factors, including the size of the business, the number of owners, and specific business goals. For example, a small family-owned business might benefit from a sole proprietorship or an LLC, while a startup seeking venture capital might prefer a C corporation due to its favorable stock issuance structure and potential for growth. Third, a combination of entities may provide the optimal outcome. In some cases, using multiple entity types can offer benefits that a single entity cannot. For example, a holding company structure may involve a parent C corporation with several subsidiary several subsidiary LLCs. This setup allows for the parent company to benefit from C corporation attributes such as easier capital raising, while subsidiaries enjoy LLC advantages like limited liability and pass-through taxation. And then lastly, changes in legal or tax conditions may require adopting a new entity type. So changes in laws or regulations can impact the suitability of a business entity. For example, if tax laws change to offer better benefits for corporations, or if a business expands significantly and requires a more complex structure, it might be beneficial to transition from an LLC to a C corporation. Similarly, a business that originally started as a sole proprietorship might convert to an LLC or S corporation as it grows and seeks additional liability protection and tax advantages. So with that, that's it for today. Thank you very much. And again, since our services are free and donations are crucial, they are very much appreciated. Additionally, those who can volunteer their time, expertise, or help spread awareness are a great help. And then again, to make a monetary donation, go back all the way over here. If you go to taxpayershelpcenter.com and then click on the Make a Donation tab, you can do it there. It's also highlighted in red on this photo. But yeah, again, anything is greatly appreciated, as it allows us to do what we do here at the Taxpayers Help Center. And so if you had any questions about anything during the presentation, please email us at info@taxpayershelpcenter.com, and your questions will be answered by a tax professional. And so with that being said, thank you all for listening and have a great day.